Good morning, everybody. Welcome to the Flow Show. Are we all having fun? I hope you are, and I hope no one's had any horror stories with what's going on in the end today. Morning, K-Man. Nice surprise to wake up to.
Hey, good morning, Ryan. Yes, it was, well, as I said in the room, it's half-half. I had an offer just above the top of the day, which is that was a bit of a disappointment not being executed. But then I was happy, of course, to see that they intervened and we could get our Friday sales back at lower levels. So that was a nice surprise. Here we are. The yen is an emerging market currency.
Yeah, for the next
Well, I mean,
few
it's taking
sessions
over
anyway. Yes.
sterling, right? Remember people calling sterling an emerging market currency? So now
Yeah, that's right.
the yen has
So
one.
we're back with the yen. Yeah. Well, in one sense, I'm glad you didn't get your 160.50 offer, Phil, because that would have been the stop of my short. So
Yeah.
we both made money. That's the main thing.
Oh yeah, absolutely.
And I hope a few people made money as well on the back of that. Right, let's get into it. I'll get through the headlines pretty quickly because obviously there's all this stuff to talk about. We had a ton of data. Well, let's go over the last week's stuff quickly. First, PCE in the US, that came in a bit unchanged. The core PCE, that big number was expected to fall 2 pips, came in unchanged at 2.8. PCE actually went up more than was expected year on year. That number there, the month-on-month numbers were potentially expected to go a bit higher based on the Q1 data PCE we got on Friday, but that came in as expected. Overall, sticky. That's the main thing to take from this. Looking a lot of the same like it was in the CPI report, where it's looking sticky. PCE tends to lag the CPI data, so maybe it's now starting to do its sideways thing. Either way, it puts a bit of pressure, more pressure onto the Fed this week. Over in the Michigan, numbers a little bit softer, not a huge amount, but the main numbers coming in softer, expectations, sentiment, current conditions. Again, the important number, 1 year inflation expectations gone up again, 3.2% from 2.9%. The 5 year staying unchanged over the flash number. So again, those inflation expectations are going to be watched closely by the Fed. They want to see expectations more along the lines of their target rather than higher. If consumers think prices are going up, then they bring forward spending habits, which can cause a bit of a slowdown later on. Buy now, don't buy later, sort of thing. Right, so that's that. After that, the Citigroup cut their Fed forecast to 100 pips of cuts this year. They still think 4 cuts this year. That's down from 125 pips in cuts that they forecast in June. So they still think they're going to be going, and the Fed to cut from July rather than June. Now, all these data have got the market in a bit of a tizzy because option players really don't know what to cover. They are covering both hikes and cuts for the Fed now without the money options. So a little bit of uncertainty creeping in as to which way they should be positioning. On the political front, there was a piece out last week that Trump is apparently going to, if he gets back in office, he's going to get rid of Powell and potentially put in place laws that makes the president able to control interest rates, set interest rates. I don't know how far they'd go with that. That'll be a big upheaval. So I don't think it's going to be a day one thing, but that's the sort of stuff that's now bubbling under the surface with the election. And speaking of elections, it's going to be a big week on the 2nd of May because we have widespread local elections going on in the UK, and this is going to be watched very carefully for voters' intentions ahead of the potential election. And Sunak apparently is at risk of having rebels in his party wanting to get him out before the election if they suffer big losses in these local elections. And the political heat isn't over either for the BOE, because the divided, this is the FT calling them, divided Bank of England faces some political heat over calls for rate cuts, which obviously the incumbent Prime Minister would like to see some rate cuts and easing of interest rates going into an election. Latest on the election date, there are threats from Sunak that if his party do misbehave over these local elections, i.e. start causing waves, he could call a summer election, which would not be favourable to anyone in his party. They'd have little time to prepare for it, make changes to the leadership, and it would spell bad news for them. So they want a later election, but we're in political game mode at the moment, so all that's going on. Right, let's get into what happened. Okie dokie. So quick rundown. Friday, late into the close, we got a pop through 158. I just put on another bit of short 157.89, and then about shut my machine down. Then 10 minutes later, we got that pop through, so I missed all that. We opened up around 158 on Sunday in the interbank, trading down to around 157, 70s, 80s when retail came online. Not too long after, or later in the morning, morning, we had that jump spike up to 160, 20 odd. I think some of the prints that we've got, 160.17 according to Bloomberg. Then what followed was a spanking, which looks 99.99% intervention, just given the size of it, all the way down to 155. Obviously, everyone's scrabbling around, wondering what's going on. Then in the morning, we've had a bounce to 157s, 20s, and then another hit down to 154.50 before another bounce. And first things to say, okay, we've got a lot of volatility at the moment, okay? You can't trust your levels too much. You can't trust some of these moves. Rallies are likely to be hit for the moment, be it officially by further intervention or just a more nervous market. That's not to say this is going all the way down to 150. But this,
yes, please.
But right now, there's a high level of volatility and uncertainty going on here. I'm not touching it at the moment. I'm flat, and I'm happy to stay flat and let the dust settle for a bit. Does this mean we've seen a top at 160? Well, that top was that level was pretty important, as we've been showing you for the last few weeks. Big, huge level going all the way back to this area, 1990s. So funny enough, we've knocked it on the head, and that's where we found a top, be that by design or by intervention, whatever reason. It's shown up as a level where we expected it to show up as a level. Does this mean, as I say, that we're over and we're going to 150? Not necessarily. You've got to know the Ministry of Finance's objective. That move last night was massively speculative. Nothing else was moving really. Low liquidity, Japanese bank holiday, someone's decided to have a go, okay? And they've pushed the buttons too far and they've got a response, okay? The Ministry of Finance is all about speculation and volatility. So they've hit it on the speculation front, they've hit it on the volatility front. We have every chance of going higher. We could go higher from here to 165, 170. But if that happens over 4, 5, 6 weeks, it's very unlikely they will intervene. If we go from 155.75 trading now to 159, 160 in the course of half an hour, that's getting back into speculative and volatility mode where they might come in again. Canda's been out already saying that he won't comment on FX levels, or he won't comment on intervention, won't comment on FX levels. They don't have a specific level, blah, blah, blah. But then he's also said that we will continue to take appropriate action on excessive FX moves. So read between those lines. We also have the Ministry of Finance intervention report that they release each month, which was due right about now, but the bank holidays obviously messed it up. So we were wondering whether we would see the intervention on that report for this month, But if they've only counted up till Friday, we won't. Canada's already confirmed that by saying that intervention won't be disclosed until the end of May, when we get the May report. So this is part and parcel of the way they play it. They don't come out often, or very, very rarely they ever come out, if at all, and said, yes, we've intervened. They want to keep the market guessing, even though we're pretty sure they have. And he's played that further by saying no one will officially know about intervention until late in May. So here we are now. Kay, what are you going to do with this?
Cash, nothing right now. I still have my put running until tomorrow, the 152. I'll wait to see if we get any extremes trading. I may try it again if we get Friday style moves like I did on Friday into the close. But for the rest, no. Right here, I don't think right here there is anything to do at all. The rally up to over 160 has, I think, well, first of all, the reason that they didn't intervene on Friday, but it happened in the fixing hour, and it also I think they went to hit barriers at 160 because even before the interventions, it already traded below 160, right? So I think we went up to call it 160, 15, 20, and then traded lower. So that's kind of typical for the barrier. It's kind of around the timing of the fixing as well. So I think there's both that in play, plus the speculators, of course, thinking that they have a free right to sell yen, and then afterwards it's well, it's now 99.9% likely it was interventions, because Kanda already said during our night that he won't comment now, and I think the now was the was already the giveaway that they did intervene, and then as you said, the next lines later, they did intervene. So is it a big move? Yes, we have seen, if you take from top to bottom, we have seen 570 pips, which is sort of the amplitude that we saw in past interventions, which was anywhere between 400 and 600 points. The thing is, though, as I was saying already earlier, the longer they wait in former shows, the longer they wait, the more it's going to cost them to put it back to levels where they perhaps would like to see it, which is around 150, in my opinion. But yeah, they really reacted on the speed of the things, and on the fact that 2 BOJ meetings further, the market is still heavily selling yen. The fact that we are now above 155, I think, is already psychologically not a very big victory for them. And as I said, yes, we saw 570 pips from top to bottom, but psychologically, this is not a victory yet for me. And now we can start the big debate. Do they really want dollar yen lower? Do they say, I can't do anything about it, but, oops, am I losing my internet here? We can't really do anything about it, but to slow moves and try to calm down speculators. That is something that we will need to see later. Again, I'm just going to reiterate to what I've been saying endlessly, is that for the yen to materially strengthen, then they need to be different conditions. And one of those major conditions is the rest of the world slowing down around it, which for the time being is not yet the case. They could now speculate on what's going to happen at the end of the week, the US jobs report. If that comes in weak, then perhaps they will have some more ammunition to try and strengthen the yen. But for the rest, if they keep it just to this intervention, all else equal, it's I don't think it's going to work for very long.
No, very much so. Now, with that, well, just quickly, we have to learn that what they want to do, as said, they're not here to pick a level and send it below a level as much as they may like it. They're here to take the volatility out of the moves. You know, the intervention we got in 2022, you know, it still went on to 152, up near 152. They didn't slow it down. The last few times when intervention when they've been intervening and the market's turned has been when the fundamentals changed or an event happened. As I mentioned, in 2012, they were intervening late 2021, and then we had Abenomics kicking in, and that, you know, got us off the floor down around the 75 mark, right down here. Then this first move off of 152 was inflation in the US dropping back, and then the market going, okay, where's the Fed going to top out with rates now? They're in their hike cycle. We remember early 2023, the pivot brigade, as we called them back then, were trying to guess when the Fed were going to turn. And that helped them on their way as well. Not that it lasted. So they're going to need some help with this, Kay. You know, like you say, with the date, whether it's US data, whether it's Japanese data, and then monetary policy, they're going to need something more to turn this around other than intervention, or they're just going to be putting speed bumps in the way of this going to 170.
Oh yeah, definitely. The one other thing that could happen, but then I think Canada already threw that into the lake when they did not move on the interest rates is a surprise hike. There is a path, but it's kind of a ploy. It's kind of a plan that they would have to put together. There is a path for the yen to strengthen, but that is, as I said, a big plan. There's a surprise hike from the Bank of Japan, and then a plan with the Japanese insurers and asset managers to come and then for the Bank of Japan to reduce at the same time JGB buying, and then wait for the Japanese insurers and asset managers to come and fill in that void when interest rates will have risen far enough. The problem is, and that brings us back to day one of Ueda's tenure, that is that close cooperation with the government. The government has huge amounts of yen to finance, and Ueda and the government said that they would work closely together. So, I mean, are they willing to throw this plan into the water? That does not seem the case right now, unless we get a very big surprise. So that brings us back to just one reason why yen would strengthen, and that is the rest of the world slowing down. And the problem is that we're starting to get green shoots out of Europe, and that's adding another issue to the yen right now, because the thing is, if you're only combating one or the speed in one currency, that's fine. But if you look at the rest, is also doing relatively okay, and then especially versus the yen doing really, really, really well. So that is another issue for the yen. So the yen is really or MOF, Canada, Suzuki are really fighting a battle on multiple fronts. And apart from slowing the move right now, this is about what they can do unless they really throw a few $100 billion at this and do as SNB style, an inverse SNB style intervention, saying like, well, the yen is 150 offered for the amounts that you like, right? But that is a big statement, and it's the wrong side of interventions. If you buy dollar yen, you can print yen and then sell it. If you need to sell dollar yen, that's a different issue, right? Because then swap lines come into play, or they need to sell treasuries, which they really don't want right now, especially not at those levels. So I mean, yeah, it's a very, very difficult situation for the yen all in all still.
Yeah, and that's one question I wanted to ask, because it's doubtful that they would have been all this move. You know, they may have been 200-300 pips, and then the market does the rest. And do you think they hit it again when we had that bounce to 157.20s?
Yes.
Because that was quite a sharp move down to 155.
Yeah, I think so. I think they did at the European Open, and that's why I was, I've been talking about that as well, and especially in our room, putting next several scenarios, showing several scenarios what they could do, and that's why I was watching very, very closely what was happening in the euro dollar, for instance, because they could have asked ECB to join them, and the BIS as well, by the way, because the BIS is used as being the central bank of the central banks. They are regularly used as well. But I don't think, unless ECB did some kind of intervention just on behalf of the Bank of Japan and then did dollar yen. But I clearly think they intervened at the start of the European session. So my best guess is that they just did it themselves, or use their agent banks in London or in Europe, and perhaps BIS. But we may never know that unless we see it in some statements coming in.
Yeah, very much so. So yeah, so there we are. We don't think we've had help from any other central banks. It looks to be all the MOF via the BOJ and their agents and whatever. So now we are pretty much in wait and see mode to see what happens next and what the market wants to do with it. Does it want to have another go, or has it had its arse slapped and is going to take a while to get back into things? So very, very volatile. Very jumpy, very dangerous to trade at the moment. Be wary of that if you're trading yen pairs. And just to show you, this is what the intervention page looks like. This is the March report, as you can see there. Total amount 0. So we're going to have to wait till May to see what number pops into there. And that's of course if they've done any more between now and that report date as well. So we're going to be guessing games.
Yeah, you know, Ryan, I think what this also means that they will only show the amount at the end of May. I think now there's two reasons for that. The first one is that they don't want to show, of course, they don't want to show it straight away to have to keep the market guessing, but it also sends a message to the market saying like, well, we may not be done here, guys. So so beware. I mean, it's a communication trick that they use there, I think, to delay those numbers until the end of May.
Yeah, exactly. And I pointed out in the room that there was a bit of risk from this April report, because if the April report doesn't include today's intervention, you could get one of the wires pumping, trying to spin a headline, no intervention in April, and then the market thinks they haven't intervened, and we see a big jump in the yen, which everyone jumps on, and or yen pairs, and everyone jumps on and fades that move. But now Candace put that to bed. We can rule that risk out anyway. Right, so let's move on for a bit from all that intervention stuff, and let's have a look at what's coming up this week, because we got quite a big week coming. I haven't even gone through the data from today yet. We got a load of it, so let's have a quick look there. There's a lot of inflation out this week, preliminary numbers, particularly from Europe. We've already had Spain out, as you can see there, coming in slightly softer CPI, core CPI coming down a bit, but the HICP measure going up as expected. So that's the one, obviously, that the ECB will mainly be looking at, the Eurozone measure rather than the CPI measure. But that's also gone up a pip from expectations, and up from last month by a pip. Missed expectations. We've had the regional German numbers coming in as well, a little bit mixed. Baden-Württemberg down, Bavaria up, Brandenburg up, Hesse up, North Rhine unchanged, Saxony up. So overall, we're seeing largely higher numbers there. They've all mostly got a 2 handle on it, so that's maybe not a big deal there. We do have the flash number coming in at 1 o'clock today from Germany. That's the main headline German number coming in there. Eurozone data is not until tomorrow, so we'll have a look on the calendar. So as you can see there, we got the main Eurozone inflation number there, which is obviously going to probably further cement a June cut, but if it's really soft, then that's going to get the market hopping up and down for another quick cut in July. It will certainly get the doves chirping, no doubt for that. But if it's round about as expected, and inflation is expected to be unchanged, 2.4%, but the core shifting a bit, then we're probably going to just do not a lot, and June will be further nailed on in the market's eyes. But as you can see there, we've got further data coming out there. Some data from China, Aussie retail sales as well, Japan retail sales. So plenty of data to come this week as well. It's obviously Fed week. Now, we do have another holiday on Wednesday. Some markets in Europe are going to be closed, and other places as well, for Labour Day, 1st of May, which is also FOMC Day. So we could have some lighter liquidity conditions for trading on Wednesday. So take that into account as well. Some calendars are showing that the UK is closed. It's not. Unfortunately, we will be here. Our bank holiday is next Monday. But yeah, so we got, and it's also jobs week. So plenty of data to go and take into the Fed, last minute data points and whatnot. Keep an eye. So tomorrow, consumer confidence. That could be a big one ahead of the Fed, particularly those inflation expectations tomorrow. Then on Wednesday, we get ADP. Then we get the ISM manufacturing as well, JOLTS, and then the FOMC later on. And what is Powell going to have to say about the recent inflation pop? We obviously last heard from him when he was talking with Macklem at the BOC, saying that it might be appropriate to keep rates higher for longer. So the market's going to want to know, are we still getting cuts or not? Or has that idea shriveled up further? Into Thursday, we get some final manufacturing PMIs, and bits and pieces coming through there. As their final numbers, they shouldn't be too shattering and big changes from the rest. Challenger layoffs, again, another one just to keep an eye on. We've heard of more layoffs coming into certain firms. We hear about the big firms, but there's also smaller firms we don't hear about. So this one's going to see if we're going to be getting some bigger job cut numbers, obviously with the connotations for Friday's NFP as well. And on Friday, that's what we get, NFP and the services PMI afterwards. So again, that's could be a fairly big number because it's obviously the bigger component, services of the ISM there. So coming after the jobs, and jobs being the usual lottery there. Anything, well, it's probably obvious, but anything else there, Kay, that you're focusing on in particular?
Well, the European CPI should be very interesting because we just heard from ECB's Wunsch that he said that we should not really bank too much on a July cut by the ECB yet. He wants to keep all those expectations in check. And it does seem that they already have agreed to cut in June. That's what we've been saying on the shows as well of late. It does seem that June is really done for the done thing for the ECB, barring huge surprises. But they're already talking about July, and there's now the interesting discussion about, because the Hawks will not want the market to start pricing in cuts at virtually every meeting of the ECB. So that is something that they want to keep in check. But it does seem that the European rates, let me just quickly verify what I'm saying here is that, yeah, European rates have come off a little bit. Yeah, for the rest, it's again with FOMC jobs reports. It's a big week for the dollar again. The big question comes back every month: will this big labor market domino hold up or start to wobble and fall? So that's going to be the big question for the dollar. And then I think it's actually, of course, we are saying that every month, but looking at the global levels that have been traded in the market on the dollar pairs, take apart a bit the yen for a minute, right? But look at levels that held in the euro dollar, levels that held in the Aussie, levels that capped even in the dollar Swiss, held in the cable. We are going to need to see a very good report again to take those levels through, because it seems the market is again looking at, are we going to see some weakness starting to creep in the US economy? So that is again one very interesting development that I am going to watch anyway, and that I think that we should be keeping a very close eye on, because just those levels in that we have been trading and that are holding, right? So we need a new catalyst, and the question is now this week, are we going to get it for the dollar? Yeah.
Yeah, very much so. And it's going to be a funny one, because Powell could come out all hawkish or more hawkish or less dovish at this meeting, and we see the dollar rally, and then we get a stinky NFP on Friday, and the market's going to do another one of its complete 180s. So we keep saying this again. It's a situation you can't marry a position, you can't have a bias for longer than the next piece of data or next event, because it really can flip around. And so it's if you're trading this week and you're trading these data points, don't take something on board, a good data point or a more hawkish Fed, and think, yep, this dollar's going to go to 105 in the euro, or it's going to go to 160 again in dollar yen, because all it takes is a poor NFP or a bad ISM, and we flip around again, and then the market's questioning and then having to wait for the next time Powell pops up. So, if you're trading these data points, these levels, these events, if you get in a good position, if you've got money on the table, take some profit, lock up the rest, protect your stops, and then see what it wants to do, so you don't get caught out. Yes, Gav, I am itching to say that, but I'm not. I'm not going to say that on a Monday. Watch where the week closes. I know you got me to say it, so I'll blow that already.
I mean, in the way I look at this week for the dollar, only looking at the dollar, I'd argue that the jobs report is more important than the FOMC this week. Because barring, I'd still think that yes, it has to be a bit more hawkish Powell, but that should be within the expectations. The surprise would be that he is not hawkish enough. But barring that, they may say something about their plans, but they've already said most of it. The plans for QT. Saying something about the quality of jobs, perhaps, but in theory, to me, the different jobs reports this week will be more important than what the FOMC should be. Yeah,
I'm slightly different. Well, I'm sort of slightly different. I think he gave us the nod in that chat with Macklem. I think his comments there are going to be repeated largely in the FOMC, so it shouldn't be a surprise. It just depends whether the market is looking for more and whether it's happy with what it gets. But I think there's a danger with if the NFP is bad on Friday, I think there's a danger of an overreaction. One bad NFP doesn't suddenly mean that the jobs market is collapsing and unemployment's going to 7% or anything like that. It's going to need a trend, but the first time the jobs market posts a negative number, it's going to be a big event either which way.
Yeah, I think so.
I wouldn't say, one bad jobs market, jobs data, that's it, that's the end. Where they're going to be cutting next week and or the next meeting, and we've got 5 cuts coming. That's not going to be the case.
But the reaction will be relatively big, because he told us that he started to look at the other side of their mandate as well, the second part of the mandate, which was not only price stability but also employment. So he actually gave us the hint that we should really be looking at it very, very closely. So I do think that any big miss is going to trigger quite a big reaction. And just wanted to say, according to what we've heard in his press conferences or interventions that he had with other people, he doesn't seem to have those numbers 24 or 48 hours before we do, because I recall one. When was it? In December or January or so, when he spoke, and then 2 days later there was a report out saying the complete opposite of what he was trying to vehicle as a message.
Yeah, exactly. I think it's only been Trump that's done his little jig before data points. So maybe if he gets back, we'll be getting those heads up again. But you're spot on with that. Right, so in the meantime, we've got plenty to watch. One thing I'm going to be keeping an eye on, obviously, is yields, and it's probably wise if you all keep your eyes on the yields charts as well. 2 years, of course, we've been knocking this 5% level. I think it's going to be a potential maker or breaker this week. Obviously, if Powell's hawkish, we're likely to push through here, maybe leg up. That'd be something that will help the dollar. But you've also got to look at what yields do versus the dollar. Could go naturally either way, but yields, if they go with it, that will give you a secondary input. If yields don't go with the dollar move, like if we can't hold above 5% here on a more hawkish Fed, that's going to put the brakes on the dollar and could see it pulling back a bit after any initial move. So we've got a good range here in twos. We know where the Fed 2-cut level is. You know, this is just a rule of thumb. It's not definitive because this is obviously 2 years and we're dealing with what happens with policy this year. But it's a good rule of thumb to look at where the expectations are. So that's where we would have 2 cuts, 4.875. And we're trading up at 5. So that's only indicating roughly 1 cut.
Actually, I was actually going to show this 2 year because it's interesting that 5% dead is the 1.5 cut only. So we're trading somewhere in between the 1 and the 2 cuts now. 5% is 1.5 cut, which is 37.5 BPs versus where the midpoint of the Fed funds are. So 5%, I think, in the twos. If you look at where we are on, especially after the FOMC and on Friday, this is probably going to be a good enough hint at where the weaker side of the market would be. Weaker side of the market, not strong or weak for the dollar, but the weaker side of the market. If you trade well above 5% come Friday after the NFP, I think the dollar is going to be big. If you're closer to that 487 or even below, then I guess the market will see a dollar reaction and sell off a bit on Friday.
Yeah, exactly. And also keep an eye, as usual, on tens. We had a little mosey above this 470 area, but we're back below. Again, that's probably putting a little bit of the brakes on the dollar move as well. So look at twos, look at tens. You know, you don't have to be a bond trader just to know what these are doing and their respective effects on the dollar. Right, I've not even looked at much else this morning, bar just to check and see what else might be moving over that intervention. Euro dollar, we're still mooching around this 107 level. Bounce has not been huge today, or it's dipped. We were up at 107.20s, near 30s, or near 40s, and we've had a little test of 107. That's held. So at the moment, we're probably in that Fed orbit where the market's probably not going to get too far out its pram in pushing a move either way, unless we get some big data like from that Eurozone CPI tomorrow. So for now, we're probably going to be into a little bit of range playing while we get towards the Fed as well. Cables quite similar, still here mooching around, not really looking to go anywhere. We've had a half-hearted move down towards 125, couldn't quite get there, and then a little bit of a bounce up there as well. Euro sterling, this is apart from this and dollar China, this is the only position I've still got in. It's continuing its bleeding lower, so I'm going to look to see maybe we get another move down to this 85 level for me to add back to my longs, all being well. I'll be keeping an eye on the CPI report for that, just in case it's much lower than expected. If we get CPI that's expected unchanged at 2.4, coming in real bang on the 2% number, or even with the shock even less, I think the euro might be in for a bit of trouble because everyone's going to ramp up cut expectations. That might be something that does for this 85 handle finally. So I'll be looking at that closely. I may even get my sell stops back into this one below this bottom of this zone here. Kay, anything you're looking at the moment? Or have you not managed to get off the yen chart yet?
Huh?
Have you managed to get off a yen chart yet?
Yeah. Oh, yeah. Oh, yeah. I've got a few. There's one a bit in the euro dollar right now. I haven't been trading much. I just traded the corporate flows on Friday. It was just like a couple of hours trading the euro dollar. We are still in end of month territory, so there could still be a bit of flows to be done in various dollars. But then looking at what the equity markets have done over the past sessions, there's less, I think, less real dollar buying to be done. We could see again another move today. A lot of times it's actually the day before the actual end of the month, which is where the bottles are the most right. Still calling for dollar purchases, but we'll see. For the time being, I may not. I may just not look at it. Euro dollar, as I said, this is combination of that European CPI and the Fed, and then the NFPs towards the end of the week. This is really, for as long as 106 holds, I wouldn't fight it. I wouldn't go for trying to go for the break. But we have a bit of an interesting little bounce going on here. A little channel now forming. Some say it's like a bear flag, but the longer it goes, the more it looks like an inverted wind sack than a bear flag, really. But we are in this little bit of a trade, well, a scenario right now. So 106.85.90, I would say, is your first level to keep an eye on for the start of the week. And then on the top side, either you take this level here, 106.45-ish, or you stretch it to 107.55. I think the battle really this week, if we get any serious hints one way or the other, the real battle for the week is going to be around 108 if we get back there. 108 break could see an acceleration to high 108s, 109, why not? If we do ever get a test and we fail again, then we are building an even bigger range, well, or stronger range, I should say, because we could be, if you look at this, since November, we have seen those spikes above, but can't hold. We could be in, which is not really good for volatility, but we could be in a big 106, 108 range building formation here. That for the euro. Not going to show cable. You did it already, although cable, I think, is on the approach of relatively interesting zone here, anywhere between 125.5 and 125.90. It should cap if we are going to continue to go lower. But and on the underside, 124.5. That's going to be the zone. If we break back below 124.5, we could go lower. Don't be surprised to visit both sides of that range on end of month flows, because when I look at some of those equity markets, especially the FTSE, I would suspect, everything else equal, I would suspect that we may see some small sterling sales into the end of the month. But for the time being, I'm not at all positioned for it. And if I do, it's going to be really the hour or the couple of hours into fixings or so. For the rest, I have very little idea on what's going on in the sterling right now. Aussie, back above that box of interest, and also back above the trend line, and we retested it and we bounced. So as I said in the room, I think I'm going to remove this and just keep the 65 2025 in mind, because that is seemingly where we see more interest. The 45 is getting watered down, okay? And then on the downside, again, I would look at 64.80. Top side, still pretty clear, although we had those spikes above, but 66 the figure, 66.20 and then 66.40. Those are your levels if the Aussie has to push further into into the course of the week. We do have Australian retail sales coming up. When are they up? Tonight.
Tomorrow. Tonight, tomorrow, yeah.
Yeah, tonight, tomorrow morning. Yeah, so I think those may be a bit of a mover. I lost them, by the way. Were they not supposed to be out? Okay, well, never mind. Could have been looking at something wrong. Oh no, we do have them out next night. Okay, so these are your levels here on the Aussie. I have to show something in the mix here because we had a retest of 1739, 1740. That was last Thursday, and that got rejected again. I'd say 1740s is again your level that you want to watch. And on to the downside, we are trying to build a bit of a support trend line here. I haven't drawn it yet, but I know it comes in at around low 17s again. Okay, to really go lower, dollar mix has to get back below 16.90.95. For as long as that doesn't happen, I think we are now forming small a range here between 16.90 and 17.40. On the euro mix was actually pretty interesting. After the spike, we had a retest of 18.50.55 and failed there. So after the scare that we had again, spike here, coming back down, rejection, spike again, and rejected again. I think this trend line is maybe a little bit fragile, but especially 18.50.55. Keep an eye on that level in the euro mix because we are starting to trade a bit lower, and I think that is also one that I'm going to keep a very close eye on over those European CPIs. Okay, and then we have to look at it, right? So Ryan already showed that 160.5. What I find interesting is that on 2 occasions, post Bank of Japan on Friday, 154.95, I think we printed. And this morning on the interventions, okay, 154.5 because there was a lot more violence in the or speed in on interventions, and probably people got stops around there, which had been done. But I think give and take pips, 155, 154.80, 154.50. It's your level, your first level of monitoring. If they succeed to put it below 155 and hold it there, I think then we can talk again about this level here, the 152. And again, I maintain what I've been saying already a good number of times. 152 to me is, if it goes below in a natural way, then I think we are going to talk about a bigger reversal in the dollar yen. But for as long as this holds, interventions taken away, but for as long as this holds in a natural way, I think nothing has changed, and the dollar yen can remain beat. And then you can look at any of those yen crosses; it's probably going to go the same way. And with that, Ryan, back over to you.
Oh, thank you very much, mate. I've not got much more to add to that. So we've got you through what's happened with the BOJ and the MOF and the yen. So you should be set up to monitor that. Got you set up for the data. So I think we'll call it a day for today. Have a good rest of your day. A fantastic week. It's going to be a busy one. Stick with us here at the Flow Show and we'll guide you through it. Yen's on the move again. Right. Have a good day, everybody. And we'll see you all tomorrow.